Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research, to discuss if March will be a positive month for stocks or if investors should expect more chop like we saw in February. Randy, it's great to see you as always. Welcome back to Trade Talks.
My pleasure to be back, Jill.
Thank you. And what was the catalyst or catalysts for the February flip in the equity market?
Well, it's interesting because, the market flipped right at the beginning of January and equities rallied. And then literally on almost the first day of February, turned around and went the other direction. But if you look at the 10-year treasury, you can see the interest rates, same exact thing. They were exactly the opposite. So interest rates stopped going down and turned around, started heading higher. And when that happened, equities started going lower. Right now, we're kind of in a position where they're going a little sideways and the markets are trying to decide whether they want to continue that trend in March or not. Of course, tomorrow the month starts, so I guess we'll find out in a couple of days.
Is 4% on the 10-year a psychologically important level for stocks?
I think it is, only because, one, it's a big round number, which does tend to be a psychological thing. But also, if you look back over the course of the last several months where we've been in these levels, there has been some technical resistance there. Multiple times it has come up to that level and it has flattened out and then headed lower, or at least gone sideways for a while. As I mentioned, it's doing at the moment. So I do think there is some psychological resistance there. Whether it can break through, or as I mentioned a moment ago, hopefully it will start trending back lower, which means we could see a little bit of upside in equities. But I think it's a little early to know right now.
What are your thoughts on earnings as they're starting to wind down? Any read through on the strength of the consumer as retail and consumer companies are reporting this week? And we had a number that reported last week.
Yeah, so we're about 96% of the way through stocks on the Q4 earnings season right now. And as you mentioned, those companies that tend to be the very latest of the reporters are the retail sector. We've had some big ones come out this week. We had Target, we got Lowe's coming out. We've also got Ross, I think, Dollar Tree, Best Buy, Costco, of a number of others that are due out. What many of them have said is they've had decent earnings, but they've guided cautious. They've guided lower, and that tends to cause the stocks to get beat up a little bit. What we're finding is that discretionary spending tends to be down because people have a little bit tighter wallets than they did. So we still see spending relatively high, but we also see credit going up, which means people have run out of savings and are starting to use credit cards. And when rates are high like they are now, that starts to get kind of expensive. So what's happening is, with some of these retailers, is their staples are selling well, but their discretionary items are not. So you have to sort of slice out the retail segment into which ones have what the product mix is between discretionary and staples. And the ones that have a little bit more on staples may be the ones that hold up a little bit better here, I think.
Right. And Randy, as you know, technicians are fans of market history. And March, of course, is typically a positive month for stocks. Do you think that will play out in 2023, or do you expect more chop like we saw in February?
Well, I actually think more chop. I think those historical trends are interesting, but they're generally most reliable when there's not a whole lot of other things going on. As we know, of course, we're in a rate hike cycle. We have a Fed meeting due on March 22nd of this month. And it's a virtual certainty we're going to get a quarter-point hike. In fact, the odds of a 50 basis point hike are starting to creep up. They're not yet where they need to be. Generally, in fact, historically, there's never been a rate hike or cut when the odds were less than 60%. Right now, they're around 30%. So they're not quite where they need to be. But if they continue to trend up over the next few weeks, then certainly that could be problematic. What we do know is that we've also got a meeting in May and another one in June. And the markets are already telling us we're going to get a quarter point at each of the three. So that's going to continue to be a problem. And I think the chop that we've seen, it's not terribly volatile, but it's certainly above average volatile. And the market's having a difficult time establishing trends that, as we just talked about, last more than just a few weeks.
All right, Randy, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.